Good evening, everyone. I'm Akshara Menon from PMS Bazaar. I would like to extend a warm welcome to today's Friday webinar. Before we begin, we want to take a moment to express a heartfelt condolences for the passing of Mr. Ratan Tata, an iconic Indian tycoon and extraordinary philanthropist. May his soul rest in peace. Now let's shift our focus on today's discussion. Indian markets at crossroads of sound fundamentals and rich valuations. What should an investor do in this incredible relevant topic for the current market? And nothing surprised us from the upward rally that we had. And suddenly we saw a 5% drop in the market. Some of the sectors such as real estate, financial services, and autos have also been seeing some sharp declines. On top of that, geopolitical tensions, including Israel-Eastern conflict and crude oil prices, have added uncertainty. With all these factors at play, how should investors approach the markets now? To help us to navigate this challenging times, it's a pleasure to introduce our esteemed speaker for the day, Mr. Aniruddha Sarkar. He is the Chief Investment Officer and Portfolio Manager at Quest Investment Advisors, a position he held since Feb 2020. With over 17 years of experience in capital markets, he has successfully managed portfolios across PMS, AAF, and advisory services. His expertise in identifying sectoral trends has made him a key figure in capitalizing on investment themes early in their life cycle. Before joining Quest, Mr. Sarkar spent over 11 years with IIFL Group, where he served as portfolio manager for IIFL Multicap PMS since its inception in 2014. Under his leadership, the fund delivered industry-leading performance over 5 years, recognized by the industry awards in 2019. He holds a bachelor degree in commerce and an MBA in finance. Let us give her a warm welcome. Hello, sir.
Yeah, hi Akshara. I would also want to extend a warm welcome to all your investors who are attending this. I would say the next half an hour to 45 minutes. I hope they take some good points away from this event.
Definitely, sir. So let me start off with our very first question. In one of your interviews, you just mentioned markets always surprise us and it will never go as per expectations. So with that note, because with your note, let me start off with the very first question is that geopolitical these days has been become a very important factor in which affecting sentiments of the investor globally among FIS. How do you see the risk factor of the markets?
See, to be honest, I think one thing which we have seen in the last 2 3 years is that, and that's a good learning for all investors across the world and also for India, that war and economies can go hand in hand. And we have had the two big wars in the last 2 3 years, and I think there is no change in the way economies have been running. I think countries have been growing at a decent rate, both emerging markets and the developed markets. And along with that, obviously, the equity markets, whether you talk about the US market or you talk about the Indian markets, we have been making the fresh highs. So I think war and economies can go hand in hand. Having said that, I think if you see the last 6 months, as you mentioned in your initial statement, that, when you expect the least, that is when things happen. And when you expect something to happen, it doesn't happen. Last 6 months, I think, anyone you talk to has been saying that we should see a good correction in the market. Everyone is waiting for a market correction. Market correction is not happening. If I see the events from all the way from April, so from April, I think almost every month there has been some event. In the month of April, there was initial kind of the knee-jerk reaction when the regulator mentioned about valuations of small caps being expensive, mutual funds requiring to do this, you can say the stress test. That was the first, the knee-jerk in the month of April. In the month of May, you had the Indian elections, and people were kind of extremely nervous what will be the outcome. And you saw the FIs also taking out money both in April and in May. In June first week, we saw the wild swings with the exit polls and then with the actual results. In the month of July, you had the union budget, which was again kind of, people were worried that, if LTCG, STCG goes up, what will happen? You come August, in the month of August, we had the yen carry trade was the big theme because Japan increased its interest rates after a long time. And you come into the month of September, people are worried about elections in Haryana and Jammu and Kashmir. We began this month of October with money flowing out of India to China being the big theme. So I think every month, you have something or the other. But I think, market has its own mind. And to be honest, I think That is where, I keep telling investors, best way to make money is to be away from the noise and the geopolitics, as you mentioned. I think as long as it's not directly impacting India, I think there's no reason to get worried for India.
But when you say about the war, the next big thing is the one which is getting connected is crude oil prices. It often plays as a wild card to in any the Indian market, of course. If the crude oil price it raises sharply, it would affect the macro outlook as well. So how is your valuation there?
See, I would say that oil definitely, if I go back in history and see, oil and gold, these two used to always be the largest import bill for India. And in the last couple of years, I think oil prices, we have seen it move up very sharply immediately after the Ukraine war. And that was, if you remember, just after the Ukraine war began in the month of Feb, there was initial kind of the negative feeling that, this will impact India's fiscal balance in a very big way because oil being a large import bill for India will hurt us. On the contrary, something which came out, you can say, big surprise out of the box that India started buying discounted oil from Russia. And I think that was a very, very big factor which ensured that our import bill doesn't go up. And on the contrary, we were doing much better than I would say the Western countries who were still importing at a high price because they had stopped importing from Russia. So I think with the new sourcing of oil which we are doing from Russia, on top of that, with the Chinese economy, which is a major consumer of oil, Chinese economy also not doing so well. Oil prices, I don't see a major concern at this point of time. Yes, with Middle East being on a boil, we could always have those wild swings. In fact, the last week there was a lot of talk about Israel attacking Iran oil pipelines, and we saw oil prices moving up all of a sudden. Uh, by the weekend, it happened that Israel is not going to attack. Oil prices came off. So I think these are going to be very kind of the short-term movements and very difficult to take an action on that. But yes, I think from a medium to long term, India remains much more insulated compared to what it was in the past, thanks to the new sourcing of oil from our, I would say, the new oil partner, which is Russia.
Yeah, and adding to the same question, it's more like a follow-up question. Market found was a bit steep during the Ukraine-Russia war. And do you think the same will happen for the Israel-Iran war as well? Do you see it's a duplicating part, or you see not markets don't affect much now?
I think one thing which we have all seen in the last couple of years is that India's position on the world geopolitics has been a drastic improvement from a time when we were forced practically to take sides. We are now very confidently being there in the middle. On one hand, we buy oil from Russia. From the other hand, we buy the weapons from America. Both Europe and America, they want to have India on their side because they know if you have to have a balance of power in Asia, on one side you have China and Russia, you need to have India on your side. So I think India is very well positioned in all this macro geopolitics, and I think that is one smart thing which our government is doing is taking advantage of the position. So I would say that if Israel and Iran the conflict it escalates, I don't see impacting India directly, but yes, Iran is one of our oil partners, and if its oil resources get damaged, I think our dependence on other Middle East countries will increase. I'm not too sure, but I think some part of that could be made up by increased imports from Russia also. So directly, I don't see Israel-Iran conflict impacting Indian economy, but yes, in the short term, sentiments do behave because I think the way the markets are, any news of any escalation in that front leads to panic selling on our market. But that is again, as you would have seen, every market selling which is happening is extremely kind of the short-lived. Every dip is getting bought.
That was well said, sir. And also, when you talk about macros, it will be unfair if you don't talk about the interest cycles, which is on top of the town now. Apart from the US interest cycle, there are other regions like Europe was also given their, rate cut as well. So how do you see that part?
See, on regard to interest rate cycle in the developed markets and its flows of FI money into emerging markets like India, to be honest, whatever we learned in our textbooks in economics in our MBA has all gone out of the window. By history, if you see, typically when interest rates go up in the developed markets, you should see emerging markets equities underperforming. Other thing says if interest rates decline in the developed markets like US, you should see more money coming into emerging markets like India. After the recent 50 bips cut, which the Fed did, we saw FIs taking out money from India, which is again against the normal sense that money should have come. Rather, money has been moving out. Yes, you can say money is going to the Southeast market, but I would say that the interest rate cycle in the US is a bit behind the curve. And I think ECB was the first one to cut the rates. And I think they took a more proactive action because Europe growth is something which is a big concern. Uh, Interest rates declining in the US, I think, it's a bit behind the curve, but yes, growth does not seem to have weakened in America. Even now, I think, the US economic GDP growth rate continues to be very, very strong. Having said that, the big question is that what will be the interest rate cycle in India? Because RBI typically will follow the US rate cycle. Just like our RBI was a bit slow in increasing the rates because we didn't have to react as sharply as the US Fed did. US Fed increased the rates by 450 bips. We were at around 250 bips. I think even the rate cut cycle will not be so steep and will not be in a haste. In fact, the recent RBI policy meet which happened, you saw the rate cuts were not there.
Not
People had expected that at least there are 25 bips cut will be there, considering the US Fed cut 50. But I think we are in no hurry to cut rates in India. So I think if the rate cuts are not being cut in India, it shows that our economy is doing well. There is no concern on the growth, and also inflation is all tamed. So I think we are in a very kind of the comfortable zone at this point of time. It sounds too good to be true, but yes, as of now, there is no concern.
so which means the correlation between the two economies, it's more like neutral. There's
Yeah,
no.
I would say to a large extent, India has, you can say, has some kind of the negative correlation with, whatever is happening in the rest of the world.
Okay, that's okay. Fine. And also, when you talk about FIs moving and money coming into the economy, you can see the boost of China now, and most of them they feel India is now an expensive market, and the money is flowing into China. So, do you think this scenario is going to continue, or you think the money would flow in back in India again?
It's a good question you asked because I think in the last 1 week, many of my friends who have no clue about what is there in China, they have been asking me how to invest in China. So this actually shows that it's a herd mentality which is catching up. To be honest, if you see the returns of the Chinese economy in the last 4 years, 5 years, 6 years, it has all been the negative to flat return. And during the same period, India has massively outperformed. The last 10 years, India has continued to remain expensive compared to China. So China has remained a deep value market for a long time. Last 4 years, 5 years, 6 years, China has remained very, very attractively priced on the valuation. So something which is value or looking cheap might remain cheap for a long time. It's not that overnight things will improve there. Having said that, the very fact that the Chinese government had to do a massive kind of economic uh, I would say, influence in their market to bring up the confidence and bring up the PMI activity and to bring up the whole infra engine over there, it shows that the pain is very deep. So I think the problems are very deep. It will not get recovered so soon. So I would say China could be more like a short-term trade, and India is a long-term investment. So I would put it in that way that considering the deep value for China, definitely the traders can, and typically, to be honest, many of the money which is going into China from FIs are mostly the hedge fund money. It's not the long term money which is going there. So I would say, yes, it's good for a trade, but not for the long term. We need to see more signs of things improving there. Having said that, I would say that one good thing which has happened for India is that our dependence on FI money has gone down drastically. The last so many years, if you look at the data on the FI buying selling in India, I think FIs have been the net sellers for several years. In fact, I was looking at the data the other day, just on the secondary market, not including the primary market IPOs and the bulk deals and things like that. But if I just look on the secondary market data, FIs have been the net sellers in 8 out of the last 11 years. So that shows that we are not so dependent on FI money. On the other hand, domestic investors have been buyers almost every year, and I think that gives me confidence that the money is moving into the hands which are going to be there with you for a long time. FI money, typically, I would say not all the FI money. A large part of the FI money is the hot money because they have access to different geographies, they have access to different markets. Anything which they see comfort, they will jump in. Anything where they see discomfort, they'll take out immediately. Unlike that, the domestic money, so people like you, me, and all the other investors on this call, we don't jump in and out of India, as soon as the FIs do. So I would be more than happy with FI money not being there for a long time and domestic participation increasing. The good part is that if I see in the last 4 years, the household savings money has moved into Indian markets. Prior to COVID, only 4% of our households were invested into the equity market. That number has now come up to around 11%, which is a very good sign that you are getting a larger population getting participation in the equity wealth creation, because ultimately it's the wealth effect which increases your overall the consumption in the country. So to be honest, I would not be too concerned about this whole short-term phenomena of FI money going out of India into the Chinese market.
Okay, just a follow-up question on it. A few days back, when I was reading the article on China, it was written that India, China was what was China 10 years back, and that is India today. So, for example, the real estate boom, it can be, or the semiconductor or subsidy which is given. So, it is like what China was 10 years back, now India is that. So, and also now China has been inexpensive. They feel China is inexpensive now. So do you, again, of course, you have reiterated it. On just want to know that if India can be a destination only for equities, because when I just want to talk about the real estate. Of course, if you want to talk about the real estate sector, uh, it can be an opportunity for China as well because it is booming. So I just want to know about it. Your point of view on it, sir.
See, yes, I would say this whole India versus China comparison has been going on for a long time, like last 10, 20 years. I've been there in the market for last 20 years. I'm seeing, ever since my initial days, I'm seeing that India versus China, this whole discussion continues. To be honest, China has definitely done a lot on the actual ground, and that gets reflected in their per capita income also. And it's very interesting data actually, way back in 1990 and 1993, India's per capita income and China's per capita income was almost equal. And we were roughly at around $400 per annum per capita income. China was at around 500. So this was the per capita income way back in the early 90s. From there, India is now at $2,400, 24 to 24 $2,500. China is at 14,000 to 15,000. So I would say on the ground they have done an excellent job with regard to putting up the large infrastructure, putting up the large capacities. You pick up any industry, China is the market leader in that, manufacturing. And I think that is what India chose to become the back office of the world, and China chose to become the manufacturing factory of the world. I think this is where that story ends, because I think if I go back in history and see after the second war, the Second World War, uh, Europe and Japan was what the manufacturing was happening. From the early 1950s to the late 1980s and early 1990s, it was all about Europe and Japan, and that is where the big boom happened. From early 1990s up to I would say the late 2020s, it was taken over by the Chinese economy. So China replaced the manufacturing of Europe and Japan, and that is where Europe and Japan saw their decline of manufacturing, and China saw its big boom. Where we are trying to do today is, I would say, India does not need to replace China. We just need to take a bite from China, which is happening. We need to take a bite from the Europe, which is the Europe plus one. We need to take a bite from China, which is China plus one. And I think our the neighboring country, which is Bangladesh, I think with the recent issues which has happened there, I think we will be able to take a bite from them also on the textile market, which I think India definitely has a lot of potential to develop. So I would say that we don't need to replace China. We can't replace China, at least in not my or your the lifetime. We'll be able to replace China. It's too large a manufacturing base. But yes, even if you take 10-20% of their manufacturing, 10-20% from Europe and other countries, I think we will almost grow by 100%.
Okay, I think that answered my question very clearly. So thank you for that. And when you talk about macros, apart from the crude oil, apart from the war, there's something which is going to affect is the US elections, of course. So what is your take on US elections and how that can impact Indian markets?
Elections, to be honest, I think we have a good record. Almost every pollster has got it wrong. So I will not want to predict what is going to happen because there is a very high chance I'll go wrong. But to be honest, I think the way the recent opinion polls have been happening in the US, it definitely seems that Mr. Trump has a higher chance of coming, but we never know. The sample size of all these pollsters is very, very different. Or rather, I will put it in this way, that if I just look at the policies for the two candidates, like Mr. Trump and Mrs. Kamala Harris, I think with Mr. Trump coming back in power, the whole Make in America is something which will get focus again. And what we saw in his last term was that he went after Chinese imports in a big way. And he put the tariffs, he increased the tariffs on the China imports. He banned many of those entities there, and he was focusing on Make in America. It is definitely a bit negative for India also, because he has been saying, if you look at the recent interviews, he has been saying that India also puts a lot of tariffs on American imports. So I think that is where some amount of bargaining will happen. But the good part is that India puts tariffs mostly from the luxury goods which come from America. Like one big topic of his concern was import of Harley Davidson from America. I don't think so. India needs to import so much of Harley Davidsons into India. We tax all these luxury goods at a very high tax rate, almost like 100 to 200%. I think that is where the big concern happens. I think broadly, if I see with some bargaining, we should be okay. But yes, with Mr. Trump coming back, focus on Make in America will be there. The other thing is he wants the weak dollar. So if you are going to make in America, the weak dollar is definitely going to be a very big factor over there, and that is where I would say we'll have to keep a watch. With the continuation of the existing government under Mrs. Kamala Harris, I think basically there's nothing much which will change from what we are today. And on the other hand, she might go after a corporate tax, which might actually move more corporates to overseas market. So these are the two things which can work out. One is going to focus on Make in America. Second one is going to go after the taxes, increase taxes on the corporates, which will actually make people think of shifting base to emerging countries like India.
Completely agree with your point when you started saying that you cannot believe your exit polls, which just happened with India. So I would definitely go with your point. So moving on to the next, let me talk about the regulatory. Even if I don't talk about the regulatory now. So SEBI has recently limited the FNO trading to protect investors. So on the side it's a positive note, but the other side it will harass the liquidity in the market. So how do you see this new regulation that has come out?
See, to be honest, I have always been a kind of a believer that equities for the long run, and FNO should be only used for hedging. And unfortunately, what happened in the last 4 years, with everyone being at home during COVID and all that, everyone became an expert, and people started buying, selling FNO in a big way. Now, what has happened is that had become a bit of an addiction, and people are losing money like anything, and all the data which the regulator and the exchanges and the platforms have been putting up, I think it shows that bulk of the money is actually made by the institutional the traders. So you have all those big algo funds and which are actually kind of making the money, whereas the retail traders on the FNO side, bulk of them have been losing money. It's not that everyone on the retail side is losing money. There are definitely people who are making money who have mastered the art, but bulk of them, 90% of them have been losing money. I think with the regulatory changes in place, I think it's a good thing because the household savings don't get wasted, and on the contrary, money moves into the proper long-term equity funds, and that is where the wealth is created. And also with limiting the, in fact, just yesterday the thing came that NSE will not be happening, will not be having the weekly bank Nifty and financial services Nifty expiry and things like that. I think these are good things because from being kind of a hedge product, or from being kind of a directional call product, it had become like a, you can say, the gambling product, wherein every week people were just buying, selling the weekly expiry puts and calls. I think that had to stop at some point of time, which I think is the thing in the right direction, and money will flow into the long-term equity funds.
So as per SEBI's report, also most of them were at loss. So I
Yeah,
think
yeah. So 90%, at least that's the data which they show, that 90% of the traders, they were making losses. Even within the 10%, it was also very skewed. Only very a handful of people within that 10% were making money. So if you are one of the 10%, you can continue, but 90% of the people, I think, have been burning hand.
got it, sir. And when you talk about the corporate earnings part of it, we're expecting the Q2 results which is going to come out. And how do you see this reacting to the festive season?
So this quarter number, the second quarter which is going to come, we just began with the numbers yesterday. You had the IT companies reporting numbers yesterday, TCS, Tata Elxsi and all. So I think this will be the weakest quarter after 16, 17 quarters. So
Okay.
after almost 16, 17 quarters, this will be the weakest quarter. Multiple factors to blame. One would be the base effect. Last year was very good. So this year on a Y-on-Y basis will be a very weak quarter. Second thing is because of elections. Typically, an election year is considered a very weak year for the earnings because many infra projects, many of those capex related projects, they get postponed, and part is that. And thirdly, I would say definitely there is some weakness in the demand from the agri side of India, which is a large customer base. So, and that is something which has been time and again been highlighted by the FMCG companies, wherein that demand growth is yet to pick up from the rural side of India. So I would these three things is what is going to lead to this quarterly numbers being a bit weak. Having said that, I think we should end this financial year FY25 with roughly around 8 to 10% kind of an earnings growth, which is much lower compared to what we saw in the last year, which was around 16, 17%, which means definitely a big drop from 16, 17 to 8 to 10% in FY25. Having said that, I think all eyes are on the festive season because that remains a large part of our economy, wherein both festive and the wedding season is where a lot of consumption happens on all of consumer goods. And whether it's apparels or electronic goods or consumer durables, even the real estate, and also along with that your travel and tourism, hotels, everything it gets consumed that time. So I would say the festive season is where all eyes are on, and by various estimates I think the second half of FY25 should be much better than the first half, which
Oh,
means second quarter will be weak but expecting the third and the fourth quarter to be much better.
okay. Okay. So thank you for that. And let us move a bit on sectors now. So when you see the corporate earnings, pretty weaker, Q2 earnings. So which sectors do you think will outperform?
See, with regard to the sectoral behavior, I think sectors which are more capital intensive, like your metals, your the real estate, cement, oil and gas. These are some things which will, I think, not be reporting very great set of numbers. Sectors where I believe good set of numbers will come. One is your consumer discretionary, more dependent on urban consumption. That will report good. Sectors which are in your hospitality sector, they will show a bottoming out of their, the margins, and margin improvements could be there. I'm quite confident on the healthcare sector. So pharma will be doing well. I think pharma is something which has definitely come out of the woods, and last 8 months, 9 months, I think definitely they are showing good promise, and that's one sector. So broadly to put it, I would say consumer discretionary focused on urban consumption, pharma and healthcare, consumer discretionary. Yes, the real estate should be weak.
Okay.
Metals would be weak. Cement will be weak. So these are the broad sectoral, views over there. But having said that, I think this is just going to be an outlook for this particular the quarter, not like a very kind of the long term the structural, just for this particular quarter.
Okay, because when you said, real estate week, I could see some kind of allocation that you've given to real estate sector. I'll come at a bit later in this part. So before that, I just want to ask one more question about the sector correlation. So, if when you how could you hedge it, because you are a big in sector rotation. So sector correlation plays a major role when you shape your portfolio. So more like having a healthcare sector, more cyclic sector. So if one sector moves up, then there'll be other sector where we need to exit out. So how do you see your sector relation? Correlation training in your portfolio.
With regard to the different, I would say the correlations between different sectors, I think it's not very high, at least. At least that is something which I've seen. But yes, like say for example, if I'm talking about, so that's the reason I bucket the different sectors into the sectoral themes, and each theme sectors within that theme will have more correlation. Like I'll give an example. Broadly, I would have broken up my portfolio into these broad sectoral themes. One would be say, the urban consumption. Now, within urban consumption, the sectors will have a high correlation. Like say, for example, one is your auto and auto anch, consumer discretionary, hotels, the real estate. All of these will have a high, you can say the correlation, because if your income growth is there, if your wealth effect is there, you will want to spend on all of these things. But if I have to see what is its correlation with, say, something else like your industrials or defense or power, things like that, definitely the correlation between that bucket and this bucket will be very low. So within industrials, again, I'll have sectors which will have a high correlation, like your infra, power, energy, the logistics, the railways. All these will internally have a high correlation. But yes, its correlation to the first bucket of consumption will be much lower. So idea is that where we see the earnings tailwinds, where we see the margins improvement, ROE improvement, where we see the earnings growth higher, that is where our allocations increase. And any place where we see, like another example I'll give you, almost for 1 year, I didn't have any allocation into IT and pharma. And both of them are more export oriented. So you can say both are again have a high correlation wherein both are dependent on exports. And if my outlook was that the overseas market is not doing well, then definitely there's no reason to be bullish on either of them. So I exited both of them, IT and healthcare, from my portfolio. But now, over the last 6, 7, 8 months, I have added both IT and pharma purely because I see the overseas market has bottomed out to some extent.
Okay, so let me ask one more follow-up question. When
Sure, sure.
economy is seeing its slowdown, and the first sector that's going to affect it is IT. But you've given allocation to IT now. So how do you justify that rationale, sir?
See, IT, I think it's not a sector which will kind of give you super normal kind of a returns, but I think it has to be an integral part of your portfolio. From the fact that I think with US recovery, Europe recovery, and also with domestic with interest rates going down in the US, typically the IT discretionary budgets it goes up, and that is where I would say the sector has bottomed out, and that's the reason why I have gradually added some exposure over there. But yes, it is again going to be very specific on which companies within the IT sector will do well. It's not going to be a very broad-based kind of a rally. It will be more specific to which sectors those IT companies are catering to, where you will see the growth picking up. So IT is not something which I would not want to have, and it is not something I would want to go overweight. As of now, I'm underweight on IT, but yes, I'm adding IT. That will be kind of the positioning for it.
Okay, thank you, sir. But sector rotation is something which every PMS house does. But how does that make you different? Of course, you've answered how do you select sectors, but most of the rations that you gave, it exists in the market, and that's the same thing which other PMS houses also follow. So how does that make different, sector rotation from your point of view, sir?
See, I'll answer this question by saying one simple thing that, and this is something I keep telling investors also, that with so much of access to information today, there is no information arbitrage. I think everyone on this call has access to all the set of information on any company. Just at your on your, you don't even need to open your laptop. You can just open your mobile phone and you'll get access on all information on any company. So there is no information arbitrage. Only thing that works in the market today is interpretation arbitrage, which is what sense you're making of what information. To give you some examples, over the last 1 year, there were many funds who were overweight on IT. There were many funds who were underweight on IT. Over the last 1 year, there were many funds who were underweight on urban consumption, and there were many who were overweight on urban consumption. So I would say that it's all about an interpretation and the outlook over there. Having said that, sector rotation as a style is something I've been doing for the last 8, 10 years, and I feel that you can't get your sector calls right 100% of the times. Otherwise, your returns would have been out of the world. To be honest, even if you get your sector calls right 70, 75% of the times, I think you will have your alpha creation in the market. And I think with regard to that, I would say I would remain a bit of the nimble footed, wherein that, if you see those indications in a sector, and in fact, many times investors ask me that, how do you decide which sector to be bullish on and which sector to be bearish on? I would say there is no magic formula. It is all about a continuous evaluation of different companies within those sectors. And it's like, then following up this, actually, I'm asking questions on your behalf. Following up on this, it is like something like, people ask that which comes first, sector selection or company selection? I would say both go hand in hand, purely because uh, when I'm looking at different companies, when we are interacting with different companies in an industry, once many companies they start talking positive, they start giving you that confidence in their companies, that is a time you feel that I think this is a sector which is going to come out of the woods. On the other hand, when you're interacting with say 10, 12 companies in an industry and you see that almost every second company is showing concerns on margins, showing concerns on volume growth, showing concerns on pricing. That is the time you start building a negative view on that industry, that, I think this industry is going through a rough patch now.
Okay, so moving on to your, most into strategies and portfolio now. We spoke more about the sectors, and some sectors where you have given high weightage is like financials, real estate, and pharma, as you said. And how do you time these sector rotations within your portfolio during the volatile market? That's how the first question. The second question is that what are the economic indicators that a investor should look out for in these sectors?
To be honest, the sector cycles, which used to earlier play out over 8 to 12 quarters, now plays out over, I would say, 4 to 8 quarters. So typically sector cycles, which I used to see that, I would want to make the sectoral shifts after almost 2 years or 36 months. Now those things happen after 18 to 24 months. So that is one part. Second thing is with regard to the wild swings, or as you mentioned, the sharp ups and downs of different sectors. Typically, I would not react on every month or every quarter. So definitely, any allocation which I would have done, I would be holding it for at least 6 to 12 months to change my view if has been a view change on a particular industry. Having said that, I would say that there are different industries have different parameters for evaluation, which we keep looking for. So there is no kind of one simple formula which applies to all industries. Whether you're talking about the hotel industry, you would want to see the average room rate, the ARRs, and also the occupancies, along with the margins which they are making. If you're looking at the banking sector, you would want to look at their ROE profile. You would want to look at their, the price to book valuation wise, and also you would want to look at the lending growth rate. If you're looking at IT industry, you would want to look at what are the attritions happening there, what is the pipeline of the deal, and what is the execution period for those deal pipelines. And on top of that, that how is the margin profile behaving? Is it improving or is it worsening? So different industries have different parameters for evaluation, and that is something which we keep doing. And we have all the checklist for different industries and different companies, and it's an ongoing process.
Got it. But there's one contract. You have high weightage on financials, but you remain underweight on banks. So how it's sounding contradictory. So how is that working, so for you?
So within financials, my view has always been for the last couple of years that I have been underweight on the banks, but I have been more overweight on the other financial services. And when I say other financial services, I'm talking about asset management company, wealth management company, exchange, platform businesses, insurance, housing finance. So these are the other financial services where I have been more bullish on. And the reason for being that is where the higher growth is coming from. Compared to them, the banks are in a very, very tight spot. You have so many banks which are, they want your and my the deposit. So it's like, they are all fighting for the same deposit which is there. On top of that, if RBI is going to cut rates, I think, you will see a contraction in the NIMs also going ahead. So on one hand, you have a headache of balancing the lending deposit ratio. On the other hand, with the rate cut impending, you will see a pressure on your NIMs also. On the other hand, the financial services which I'm talking about, where I continue to be very bullish. Just to give an example, asset management companies, they are a direct play on equity growth in India. If I am bullish on equity growth in India, I think there's no other better place than betting on asset management companies or platforms like, exchanges, because that is where direct benefit comes. Asset management companies in this quarter, I think they will report anywhere between uh, 25 to 45% kind of a Y on Y earnings growth, which you can't see in banks. You can't expect 40% earnings growth in banks. So I think that is the reason I'm more bullish on the other financial services and I'm less bullish on the banks.
But though you have few banks in your portfolio, but still the weightage is comparatively less.
Yeah, compared to benchmark, my allocation would be much lower. It's not that I would not want to have any bank, but yes, it's like, overall the weightage is less.
Okay, thank you, sir. Thank you for that. And moving on to the next sector, which I wanted to ask is that consumer discretionary. Where you seen high allocation, but I don't see any exposure in consumer staples. So can you throw some light on why is that?
See, consumer discretionary, I would put it basically betting on urban and semi-urban consumption. And that is where I've been very bullish for the last almost 18 to 24 months, from a simple reason that that is one part of the economy where I see a lot of resilience with regard to income growth and demand growth. Whatever is happening in the rest of the world, whatever is happening in Europe, America, China, Israel, Ukraine, Agri-India, this is one part of the economy which is not affected much. So consumers like you, me, and others on the call, most of us, we have seen both income growth and the wealth effect from, participation in the equity market, which has made us more optimistic about our consumer behavior. And that is the reason I've been more bullish on consumer discretionary. When you talk about consumer staples, it's mostly dependent on agri consumption. Your staples typically would be your, most of your FMCG companies, and that is where I would say volume growth is something which is still to pick up. Like you're still seeing the low single digits volume growth, which is not a very, very exciting thing for me. Like, if you're going to pay 40, 50, 60 pill, you don't want a low single digits volume growth happening. So unless I see the volume growth in the consumer discretionary, it won't give me the confidence to bet on them. And I will continue to bet on consumer discretionary rather than the consumer staples over there.
Okay. And so, when you talk about it, on your portfolio, you have given almost 40% of allocation to small caps, wherein the trend is like, to reduce the small cap allocations because they feel the valuations have been stretched in that particular space. So, but still, you have given, 40% of allocation there. So, how do you see this?
Answering this question, I will say that, I always keep telling investors that don't paint entire market cap with one brush, because everything in large cap is not cheap. Everything in small cap is not expensive. There are companies in the large cap which I own, which are very expensive. There are companies in large caps which I own, which are not expensive. Similarly, there are small caps which I own, which are not expensive, and there are small caps which I own, which are expensive. So I would say as long as the earnings is supporting the multiple, which I would put it as the PEG ratio, as long as the PEG ratio is within your comfort zone of anywhere between the 1 to 2 times, I would say that you are not buying something expensive. So earnings supporting the valuation is the key factor. I would not want to pay a 60 multiple to a stock where earnings are growing at 10-12%. But there is no harm in buying a company at 100p if the earnings are growing at 60-70%. So it's all about the PEG ratio. That is the earnings growth justifying the multiples. Having said that, I continue to maintain around 40% into small caps because I think there's a lot of growth which is happening there. And that is where the big growth part of my portfolio would be, that the highest growth in the market is going to come from the small caps. And there's a lot of good, I would say, ideas even as we speak, wherein companies are not expensive. Like, we have a company in the small cap space which has given us almost 60% return from our buying, which we did a couple of months back. And even now, after the 60% up move, the stock is quoting at around 11, 12p on FI 27 numbers. So it's not that everything is expensive. So I would say that as long as the earnings are doing well, I think you will get your the returns in the medium to long term.
Okay, so let me talk about the one new age company that you invested. But I think let me take the name of the stock, which is Zomato. And these days, most of the fund houses are giving allocation to Zomato. But you were an early finder of that. One of the early fund managers who gave allocation to stock Zomato. It was when it was a very much new age company. So, but how do you see that valuation? Basically, when you evaluate a new age company, there are six life cycles. So, from starting from startup till its decline, ignoring startup and decline, in between you will have high growth, medium growth, and then the stable growth part of it as well. So when is the time, Quest found or you found Zomato to be attractive, and when did you enter?
I would put Zomato in a very different category, wherein that we observed, our basic reasoning of looking into it and getting confident on it was purely from the fact that it had a very, very different, I would say, business, wherein it's not about that it will go from startup to being a peak and then decline. To be honest, it is in an industry wherein there are only two players. You have Zomato and the unlisted one, which is the Swiggy. If anyone wants to order food, you don't have a third option. These are the only two options which you have. I think everyone on this call, if they open their phone, these are the only two apps you will find on their phone for ordering food. So it's a market leader in an oligopoly industry when it comes to the ordering of the food. The high growth is coming from the quick commerce, and that again is, I would say, the market leader. So Zomato again is the market leader in the quick commerce with its Blinkit, and that is where I think the highest growth is coming. So when we bought into Zomato, obviously we were betting only on the food business because Blinkit was just acquired that time. It was an option value, and we were factoring in that what will be the kind of the upside which can happen with the food business growing. With see if you're confident on the per capita income of India going up,
Mhm.
the young population in India, which with a median age of 29, per capita income going up, more and more households getting into the job market. I think ordering food, eating out, these are things which are invariably going to increase, and that was a bet on them. Obviously, post that, gradually we kept on monitoring it every quarter. We met the management multiple times, and Blinkit and Zomato food business, both of them continue to do very well. And the management maintained their guidelines with regard to when they will turn profitable. And I think they have done a much better job compared to what everyone on the street expected. So I think one good thing about the company at this point of time is that Blinkit caters to a larger wallet share of every household. Uh, Typically, we would not order every day the food from outside, but if you talk about ordering on Blinkit, you would do it multiple times in a day. So
Yes.
that is where Blinkit is catering to a bigger wallet share of every household compared to the original the food business, and that is where the valuation of Blinkit has also become bigger than the parent company which was earlier when we bought in. Having said that, I remain confident on the growth potential for Zomato as a whole, and I would want to maintain the disclaimer that we have entered at a much lower level. We continue to hold it for our clients in our PMS portfolios, AIF portfolios, and I believe that definitely it's a good bet on India growth story.
Yes, sir, true. Because most of us will be have this gold membership of Zomato, definitely. Moving on to the next, I see pharma is one sector which you had larger allocation during COVID years of 2020 and 2021. And then you reduced your exposure and almost you didn't have any single pharma stock last year. But now again, I see around 7 to 8% of allocations given to pharma, like Piramal Pharma and Nacto Pharma, and being there in your portfolio now. So where do you see this, sir?
See, pharma during the COVID years, I had almost 18-20% allocation in our portfolio. And obviously, that was a time when the whole sector was going through a good upcycle, margin improvement, ROE improvement, top line growth, EPS growth, everything was, the best you could think of. Multiples expanded. Stocks which used to trade at 12 to 15p, they started quoting at, 40, 45p. So that is where the discomfort happened, that, people were factoring in that, the good times will continue forever. So that is why somewhere from the middle of calendar year 22, I started decreasing allocation into the healthcare space, pharma and healthcare. And practically by end of December 22, I was almost out of pharma completely. Somewhere in the beginning of last year, I was completely out of the healthcare space. Uh, Over the last 8-9 months, the two names which you mentioned, we have bought into them, both Piramal and the Natco. Already the stock has given us very good returns from our initial entry point, and it should not be seen as a recommendation. But I would say that the whole sector as a whole, I think, is doing well. Margin improvement is one big trend which we are playing. All companies where we are betting on, I think their margins have improved a lot. The US FDA approvals have also been coming. The other thing is with the US economy, with the US government now going after the Chinese biologic and the pharma companies, I think it opens up the gates for Indian pharma companies to get a bigger share over there. It's not a very large opportunity because I think it will take time because it's going to be implemented over 6, 7, 8 years. But I would say definitely there are no headwinds as such for Indian pharma companies, and I think margin improvement along with a good pipeline gives you comfort that valuations are not expensive.
Thank you, sir. As we're talking about sectors, so let me ask one more sector, which is real estate. I remember you identifying the real estate sector way back in 2020 and remaining overweight for a longer time. Only recently, I see your allocation has gone less. Is that you've been negative on this real estate sector? And one more question adding on to is about the hotel sector. So I need your views for both these sectors, sir.
Answering your the real estate question first. So real estate sector is one sector where we had gone overweight somewhere towards the end of 2020. So August, September, October 2020 is wherein we identified the sector and we went overweight there. Allocation towards that went up to almost 14-15%. Even over the last, I would say, 6 to 7 quarters, I've maintained around roughly between 8-9% allocation into the real estate sector. Having said that, over the last 4 or 5 months, I would say I've decreased my allocations with this particular reason that I think there's a lot of oversupply which has come into the sector. With so much of oversupply which has come into the sector, I think definitely the sector will not give you that type of an alpha which it had done in the past. So oversupply and valuations getting priced in, I think gives me the discomfort that I would not want to bet majorly into the real estate sector. Having said that, I would say I'm more bullish on the real estate ancillaries, which is all about interiors. Because with the amount of inventory which has been sold, once you take possession, the interiors is the work which begins. So I would say that now it is better to bet on the ancillaries than on the builders.
Okay.
Answering your question on the second part, which is the
Yeah.
hotel industry, I think uh, people have loved to travel post pandemic, and that behavior has not changed. You go to any hotel in any part of India, I think you always find them occupied. The room rates don't seem to come off. So I don't see a reason to be negative on the hotel industry because I think definitely that is one part of our economy wherein consumption behavior has changed and it is not going to get reversed. People have understood that you need to spend time and enjoy and travel, and that is not changing. Initially, people had thought it is a revenge tourism which is happening, but now even after so many years of COVID being over, it is not a revenge tourism. I think it's a big change in the consumer behavior, and the good part is people don't mind paying the rents. The recently I was in one place in South India, and the per night rates were at 48, 50,000, and when you inquire with them, they were all packed for the next 1 month. So people are willing to pay 48, 50,000 per night, and the rooms are packed.
Okay. Okay. Thank you for that, sir. And with the constraint of time, let me take the last question for the day, which is that let me talk about your performance now. We spoke more about sectors. We spoke more about the markets. So more moving on to this strategy and its performance. All your PMS and AF strategies have outperformed the benchmark significantly for the last couple of years. So if you could throw some light on that.
So I would attribute, the alpha creation which has happened in the portfolio over the last several years, and so I would rather tell investors to look not only a short-term period, but rather a much longer-term time period. Don't look at 6 months or 1 year return. You should see a much more longer return, 5 years, 6 years, 7 year, 10 year, how the returns have been. I think over a long period of time, say over the last 8-10 years, portfolios have done well, and I would attribute that purely on one simple fact of being the nimble footed, being agile, and keeping an eye on the ground, what is happening, and following sector rotation as a style, wherein that, don't get attached to any company, don't get attached to any sectors, and don't be averse to buying different industries. Because I see there is one part of the market which is a value investor, they don't touch the growth stocks. There is another part of the market which are the growth investors, they will not touch the value stocks. Last 5 years, if I see in India, both value and growth both has done well, which means that if you would have blocked yourself from participating in one part of the market, you would have actually missed out a big part of your alpha creation. So I would say that being nimble footed, being flexible, being agile is what I would attribute the alpha creation for our portfolios.
Thank you, sir. Thank you for that. With that, we've come to the end of the session. Of course, it was a very insightful one. We have covered almost most of the topics, including, of course, the sectors, macros and markets, also about your strategy. So thank you for sharing it with us, sir.
It's a pleasure always, and I hope investors would have taken away some the key points from this interaction.